Everybody, this is Dale Anderson. So just wanted to update you on the latest regarding the Silicon Valley banking collapse. So Silicon Valley, the heart of innovation and technology, in the last week has had a catastrophic banking collapse, which has shook the valley to its core. We've just witnessed one of the largest banking collapses in US history. Silicon Valley's bank's former parent company has filed for bankruptcy protection. SVB was the biggest bank to fail in more than a decade, with about £209 billion in total assets as of the end of 2022, the FDIC said. So once you start to dig deeper, you realize that there is a potential for a bigger banking issue here, with the saying too big to fail possibly being tested again soon. So let's explain exactly what's happening if your money is safe in the banks, how the banks could become vulnerable if people start withdrawing savings at the same time, and how you can go about making sure you are protected. So first, let's start with Silicon Valley Bank. So what's happened? This was a company founded in 1982, and it became a prominent lender through Silicon Valley, catering almost exclusively to venture capitalists. It became the startup bank where CEOs would go for funding. In 2020, when interest rates went to zero and stimulus measures were put in place, banks and people were flush with cash. Almost all of that funneled back into the banking system. See, here's the thing about banks. As a customer, you technically have access to your funds at all times, but the chances of all customers showing up for their money together is a very small chance. So banks only maintain a fractional reserve of at least 10% of their funds. They lend the rest of the deposits to debtors who are in need of funds. The interest they earn on this is what the banks profit from. There are regulations on the lending a bank can do, but in this case, the debtors they lent money to was one of the most creditworthy, the US government. Silicon Valley Bank parked £100 billion of its funds in US treasuries with a maturity of 3 to 4 years and locked it in at 1.79% in 2021. The bet in itself was not risky, but the sizing and the timing of the bet was a brash move. By locking in the funds, SVB was betting that the Federal Reserve would hike rates very slowly in the coming months. They got their prediction horribly wrong, and interest rates have gone up significantly. The Fed hiked rates much faster than SVB had anticipated. By locking in their funds at a rate of 2% for 4 years, SVB expected to get $108 on deposits of $100 for the full term. But rates hiked to 7%, and it meant that by investing $100 at the new rate, they could get $131 over the exact same time. This also meant that SVB would have to liquidate its old bond portfolio at a loss. When bond yields increase, the values decline, and the original bond would have declined to $77 in value. SVB would have to take a loss if they sold their portfolio. They could have avoided this and still held the bonds to their full term unless they were pressured to sell and realize their loss. As luck would have it, this was also a time when customers were withdrawing their money en masse because tech companies were in a slump and had to resort to using their cash reserves. SVB seemed to be running out of money to service the withdrawals, and Moody's Investors Services threatened to downgrade their credit rating, which could scare depositors. So SVB decided to sell its bond portfolio at a loss of $1.5 billion, and it scared depositors anyway. From there, things began to escalate fast. The company announced on March the 8th that it would be selling a third of its ownership in an effort to raise $2.25 billion and offset the bond losses, while continuing to service withdrawals. But word got out that the bank could be facing insolvency, and when the market reopened the next day, the stock price plummeted by 60%. Ouch. The chances of raising additional capital became slimmer, and clients started panicking. Peter Thiel even advised companies that were part of his founders fund to start pulling their money from the banks. This triggered a full-scale bank run, even while the CEO started calling clients to assure them that their money was safe. You know what they say, every banker knows that if he has to prove he is worthy of credit, in fact, his credit is gone. On March 10th, Silicon Valley Bank announced that they had failed to raise capital and were looking for a buyer because they had more withdrawal requests than cash on hand. But it was too little, too late. Just hours later, regulators stepped in and closed down the bank with this message: all of the bank's deposits have been transferred to the new bank. Insured depositors will have access to their funds by Monday morning. Depositors with funds exceeding insurance caps will get receivership certificates for their uninsured balances. And that's why it's a crisis for Silicon Valley now. If the funds are insured, there's no problem, right? Except there is. The main purpose of FDIC insurance was to provide a safety net for the small guy, and the insurance was capped at $250,000 per bank account. That works fine for individuals, but in this case, the clients of the banks were businesses with balance sheets worth millions of dollars used for working expenses ranging from payroll to overhead to company expenditures. And $250,000 was just not going to cut it. But what is the extent of the damage? So here are some quick facts. Out of SVB clients, only 2.7% fall under the FDIC bracket of $250,000. The remaining 97.3% had deposits above this limit. Gary Tan of the startup incubator Y Combinator said that the 3,000 plus companies under their wing, many banked with SVB, more than 400 companies are exposed, and more than 100 cannot make payroll in the next 30 days unless there's a quick resolution. He also said this is an extinction level event for startups and will set startups and innovation back by 10 years or more. So 37,000 customers accounted for more than 74% of the bank's assets and had an average account size of over $4 million. The collapse of the bank is sending ripple effects across the economy. It's not just clients. Startups like Rippling that used SVB's technology platform to process payrolls are also halting operations as their APIs break. Realistically speaking, startups won't lose all of its money invested in the bank and will be first in line to receive funds when the bank's assets are liquidated. But that process could take years, and the question is whether startups can raise enough capital to stay afloat until then. The FDIC will be sending customers a check for $250,000 and a receivership certificate, but there's no timeline after that. So who are the clients who are being affected by this collapse? Some prominent names are Roku, which holds £487 million, 26% of its cash in SVB, Sangamo Therapeutics, Ambarella, Lending Club, Oncorus, Eager, Roblox, Axum Therapeutics, Progenist Therapeutics, Ginkgo Bio, iRhythm, and Pioneer, to name a few. There are no doubt countless others. Not all of them will have a fatal exposure, but the effects will be seen only in the coming days. Meanwhile, can this happen to your bank is the question. It's possible, but it is very unlikely. The problem with Silicon Valley Bank is that they place concentrated bets on treasuries and were serviced by venture capital funding, which are both hit hard at the same time. I've mentioned earlier about how diversification and asset allocation are what determine the resilience of a portfolio. And while SVB had a dream run when conditions were favorable, they only had to hit one point of failure for the bank to go under. So while there are other banks that have similar kinds of exposure, they tend to be a very small part of the balance sheet, according to the Fed Vice Chair. Even if they experience the same deposit outflows, they are more insulated. So what should you do? In order to best protect yourself, you should never keep more cash than what's covered through FDI or FCA insurance, which is typically $250,000 in the USA, with an individual bank or up to $1.5 million in what's called a sweep account. Or you could stick with one of the larger institutions that are not likely to have the same issues. Another possibility is the use of CDARs, now covered under intra-FI, that split deposits of up to $50 million across a network of more than 3,000 banks across the country and let you access the funds through a single bank. But this is a relatively new development. We don't know if it will stand the test of time. Anyway, if you have a large enough sums to worry about, you shouldn't be keeping a sizable amount of cash in the first place, and you should be diversifying your investments, storing your cash across several accounts in different banks. This is not so easy for businesses to do, but as an individual, it's something you can easily do to minimize your chances of a black swan event. We haven't seen a failure of this magnitude since 2008, and it remains to be seen what happens next, whether the government deems SVB too big to fail and supports it to prevent systematic collapse, affecting thousands of businesses and tens of thousands of employees, or whether SVB will be forced to go through bankruptcy as companies watch the proceedings and wait for their day. I've got mixed feelings on this. It's terrible that companies that raised and saved up money and capital and carefully prepared for a recession have to go through a crisis which is no fault of their own. I find it shocking that a bank could lock away such a huge portion of its assets and essentially place a bet on the Federal Reserve, which could break the bank if the bet went wrong. No bank should be allowed to take such a sizable risk, and regulation should be put in place to ensure there is more diversification. When the payroll of thousands of employees is at stake and failures in payments could ripple across the industry, we need better safety measures for businesses against such unforeseen disasters. So as everybody knows in the USA, if they catch a cold or a sneeze in the banking system, there's issues, there's more chance that effect will ripple over into other countries. And especially we need to be careful in emerging markets. We've seen banking crises in places like Lebanon and other countries where people are actually not able to withdraw their own savings. So it's very scary, but as always, diversify, stay safe. I hope this video helps. Please click subscribe and like, and follow us on YouTube. We really appreciate it. All the best. Take care.